But that is not where my next guest is looking for opportunity. He's still underweight on the group and has some concerns about the U.S. economy as a whole. Michael Landsberg is the CIO at Landsberg Bennett Private Wealth Management. And Michael, as we're getting a sense of normalcy back in the markets today, the 10-year yield is down. Things feel a little bit less, alarming. How much of the recent market weakness do you think is directly because of tariffs, and how much because of an economic slowdown that might be happening anyway?
I think it's a good question. Obviously, tariffs are kind of the headline. It seems to suck kind of the air out of any room you go to. But I think the underlying economy is slowing. I think we're seeing a GDP. It won't be a negative GDP print, but I think you're going to slow from 2.5 to maybe just slightly positive. I think earnings are going to be interesting because of the fact that we had these tariffs and the consumer confidence kind of fall away in this last quarter. So I think you're going to have a dichotomy between good and bad earnings depending on when you report. So I think it's right to be a little concerned with the fact that, yes, tariffs are here and they're kind of the headline, but the underlying economy is starting to slow a bit. And I think that's something that I'm not sure a lot of the market participants saw.
And is that one reason why you're cautious both on small caps and on the megas of the mega?
Yeah, part of the reason we're cautious on the mega, we rebalanced in January and took our positions down, was they've had such a good run. And what we've seen, it's kind of been exemplified even on rallies like last week. There's 5, 6 stocks that are a third or 40% of the move. That just isn't healthy longer term. I think we got away with that for a couple of years, but I think at some point you need a broadening here. And we want to continue to we still like those stocks, but we just don't want to own as many of them. Most investors have too many. Small cap's a different story. They've been an awful group for 3.5 years. You're still negative from where you were in late 21. Earnings growth is slowly coming back, but why go there when there's so many other places I could go versus small caps and get a better return with lower risk?
And let's talk about some of those places, because again, you think a lot of names that we might knee-jerk go, hey, it's down 30%. You're saying it doesn't necessarily mean it's cheap enough yet, and that might include some of the big tech names. But there are some stocks you like here, like Nextera, like Chubb, like Axon. Where else, or why these three?
I'll give you these three real quick, slightly different reasons. We like insurance. Insurance seems to always do well. Chubb's a global player. They sell everywhere. We think they're consistent. Nextera, it's a Florida, the primary company is Florida Power and Light. Florida is a huge gainer of people moving here, and utilities need new customers. So it's not like up north where people move and somebody moves in their house. This is a lot of new construction. So we still think that's a positive. And Axon's probably my smallest or mid-cap play. They make police body cams and tasers. The body cam business isn't going to go away. And if you look, anytime you see a body cam on TV, it's an Axon product. So we like those because we think they have to do well. And again, we also like the overseas markets primarily because Europe's been such a bad place to be for a couple of years. They're coming out of recession. And I think that's a strong opportunity, again, with lower risk than it is just having all your money in the States.
To paraphrase Kyle Bass, who's no fan of investing in Europe, he says it's basically just a vacation spot and a retirement destination, but there's no reason to invest there.
Well, I appreciate Kyle's comments, but when I look at kind of the risk reward here, there's a lot of good European companies that are trading at much lower multiples, and there's growth there for a change. I mean, historically, we haven't had a lot of growth there in the last couple of years, so we think there's an opportunity there with some good names that sell globally. They just trade at cheaper multiples. And the volatility in Europe is nowhere near what it is in the United States. And I think that's a positive as well. When we've got this choppy market, I'm looking for low volatility, not high volatility.